Okay guys, all right, we've got a really important video for you to understand today. This is about your income statement or your P&L statement break-even point. Okay, so I'm going to take you through how many sales you need to get in your business to break even. Now, break even can be a bit of a confusing term, so we're going to step you through all of that today. And by the end of this, you're going to be really clear on how many sales you need to get to break even, what you need to do to hit your profit targets, and so forth. And some of the strategies you can use to tweak and tune this to maximize your profitability. All right, so let's rip in. Let's start with the first basics. I always go back to my basics with, this business we're talking about here is a P&L for 12 months, 500,000 sales, 250,000 of COGS. That means 500 minus 250, gross profit of 250,000. Operating expenses or fixed expenses of 200,000 gives this business a profit of 50,000 for the year. Now, what we're going to start to do is look at how do we turn this into units and do this break-even thing. So this is just going to be a different way of looking at your P&L statement. Now, before we do that, really important thing I want you to understand. This particular formula here is a real simple one. A lot of the times our team don't understand how much it costs to run a business. So this is what I call the key factor, and I've got a picture of a key there. So in this business, we've got operating expenses or fixed expenses of $200,000. So we've got to pay this year, regardless of if we get a sale or not, or if we're looking at last year. That was what it cost us just to put our key in the door and open it. When you break that down to a daily basis, given that we've got 5 days a week, we've got 52 weeks a year, and then you take out the public holidays and all the rest, that we have about 250 available days for us to do business. So what that means is every day, and this is an interesting figure to share with your employees if you calculate it, in this business, regardless of whether we get a sale or make any profit or anything like that, we've got to pay a bill of $800. So your rent, your fixed expenses, phone bills, power bills, insurances, all those sorts of things. Now, how that translates to where we're looking at here is this dotted line is going to represent that. So if this business video is making a lot of sense to you and you'd like to find out more about it, subscribe, click the like button down below. You're going to see there's a place where you can try my free small business financials course, where this video and a whole bunch of other videos are involved that will help you get up to speed in a minimum. If you do 30 minutes a day on this course for 7 days, you'll know more about small business finances than any other business owner probably in your area. So rip into it, take advantage of it down below. It's going to represent that. On our vertical axis, we've got dollar figure, okay? And down here, we've got units, the number of units. So we're going to look at this over the transgression of a year in terms of units. So we're going to do the example with, if we have, in our business, we sold 1,000 units, okay? So with 1,000 units, we made $500,000 worth of sales, which would mean they are $500 per unit on average for this business. And if you want to work this out in your own business, run a report for your business last year and work out how many invoices you generated, then divide that number into the sale. So in this business here, the example I'm using is they had 1,000 invoices, okay? So you could run a report and tell you how many there were and the rest of it. And we worked out then 500,000 divided by 1,000 invoices means we had $500 average sale per unit. Now, we know that our gross profit, which is sales minus COGS, is 250, or as a percentage, 250 as a percentage of 500 is 50%. So you've done these examples if you've seen these videos before. So what that means is for every unit, we make a gross profit or a gross margin, remember margin's a fancy word for what you get to keep, of 50% or $250 per unit. That's what we get to run the rest of our business with. That's what we need to stack up all of those $250 gross profits on top of each other per unit to jump over our break-even fence here. So our break-even for the year is $200,000. So how many units do we need to sell to break even and get across here? All right, now, we know that in this business last year, we sold $250,000 worth. So down here, when we started, we had 0 units, so we had 0 gross profit. But by the end, we'd sold 1,000 units and we'd made $250,000 gross profit. So I'm just going to draw a line from here to here. Now watch this. Where this line, and hopefully I can get it straight enough to hit the mark, where this line jumps the fence, as I was talking about, is called your break-even point. And if you've watched some of the other videos, all you need to do is work out our OPEX divided by our gross profit gives you what our break-even figure needs to be. So in this instance, where we jump over it is about halfway along here, or 500 units, okay? Sorry, 250 units. 250 units at 250 each is about $400,000, I think it is, $450,000. So this mark here represents $450,000. Do the calculation from the other video, but don't compare the two. This is a graphical representation, because once we jump the fence, guess what? All of this here is profit. But until we get to the fence, down here, we're still making a loss. So the name of the game is we want to get across that fence as fast as possible. And there's only two ways we can do it. We either need to lower fixed expenses, which means we cross the line sooner. We need to either steepen the curve by improving the gross margin on our product, or we need to similarly increase the number of sales. They're your three levers to move this along here. Now you might say to me, that's all well and good, Brad, but what if I have a business that doesn't have any cost of goods sold? So maybe you're professional services, maybe you sell time. Great question. In that instance, we don't have COGS. So what that now looks like, if we take out COGS in this particular example here, now our gross profit is 500,000. So essentially what happens is the point that we cross over is going to be much sooner. So our gross profit line, and this line here was gross profit, is going to be, if that was 250, it's going to be sort of up here at 500K. So instead of the line looking like this, our line will go up much steeper and hit the point up here, because we don't have to pay for cost of sales. Effectively, we've lowered our margins. So in a services business like this, you would meet the gross profit, or not the gross profit, yeah, it is a gross profit, crossing the line much earlier, but the chances are you're going to have much higher fixed expenses because you're going to have more wages and those sorts of things as well. So it's a bit of a balancing act between the two of them. So hopefully that makes sense to you. As I said, I told you about some of the tools you can do to tweak it. You may need to go back and watch this video again and again. Watch the break-even video for the calculation. And then as always, if you have some questions, post them up down below. Love to hear from you.